but we'll get started. In the interest of time, it's a couple minutes after 12, so 12 Chicago time. So we want to get started. Thank you all for being here today and for joining us for our second webinar of the week on a question and a topic that is top of mind for everybody less than 1 week before the presidential election, on what are the potential outcomes, the economic outlooks and outcomes forecasts based on who wins this big election. So thank you very much to Scott Anderson for being with us today. We've been talking about this for a couple months, and we're really happy to have you join us from California this morning. Just a couple notes of housekeeping. This session is being recorded. We will upload this recording to our YouTube page sometime this afternoon and send it as in a follow-up email to everybody who has participated in this presentation. We'll send that to you as a link, and with the contact information of our speaker. We have put, everybody should be muted. If you're not, please mute yourselves. During the presentation, we'll ask that you put your questions in the little chat box at the bottom of the screen, and we will track the questions and ask them in the order they were posed at the end of the presentation. And then after we've gone through the questions in the chat, we will open it up for discussion. We'll stop the screen sharing and let everybody see one another and unmute yourselves, and you can talk. We can all talk directly. So thank you all again for being here. I'm now going to turn it over to our fantastic board member, Brooke Kerendian, partner at DLA Piper, who is going to get us started. Thanks, Brooke.
Thank you, Andrea. Welcome, everyone, again. As Andrea said, I'm a partner at DLA Piper, which is a large global business law firm with offices around the world, more than 40 countries, including France, of course. And it's my great pleasure and honor to introduce Scott to you this morning. So Scott is the Chief Economist and Executive Vice President at Bank of the West, BNP Paribas, and he serves on the bank's executive leadership team. In this role, he analyzes and forecasts international, national, and regional economic trends for Bank of the West management, business lines, and clients. Throughout his career, Scott has been consistently recognized as one of the top economic forecasters in the country and was named the most accurate forecaster by the National Association of Business Economics for 2019. So we all know we're getting some good information here today. He regularly authors economic research reports on prominent U.S. and global economic issues, monetary policy actions, and bank lending and credit conditions. And Scott also produces periodic regional outlook reports about California and other regions. His economic research is widely read and cited by the financial and business communities, and he's a sought-after national expert and speaker on macroeconomic issues. He currently serves on the board of directors for the Commonwealth Club of California and was appointed chairman of the American Bankers Association Economic Advisory Committee in 2012 after serving on that committee since 2004. In 2015, he was also appointed to the California Council of Economic Advisors. Prior to joining Bank of the West, Scott was a senior economist at Wells Fargo, and he's also held positions at Moody's Analytics in Philadelphia and the International Monetary Fund in Washington, D.C. So welcome again, Scott. We're so happy to have you, and I will let you take it away.
Thank you, thank you, Andrea. Thanks for having me today. Hello, everybody. Sorry we have to meet here virtually. I'd love to get back to Chicago soon. I grew up in Minneapolis, so I'm a Midwest boy, and I always love going to the Windy Cities. So let me start with kind of laying the groundwork. There's a lot to cover today. There's a lot going on economically, politically. We got an election coming up with less than a week. You know, I was just thinking about what I was going to talk about today and just kind of reviewing in my mind all that has happened this year in 2020. This is, and the word unprecedented just keeps popping up into my mind as we talk about all these things. So we're in a pandemic, one of the worst pandemics in the global economy in modern times. We really we had a Spanish flu pandemic in 1918, but we didn't have a lot of good economic data back then. I think the only thing the US was tracking back then was industrial production growth. We know at that time it had a pretty significant impact on economic activity in the US. The Spanish flu did. It lasted for 2 or 3 years in terms of the depression it had on manufacturing activities. So we knew it was going to be bad when this pandemic started. I don't know if anyone thought back in March and April we'd still be having difficulty controlling the spread of the virus, and we thought we'd see a little bit more of a light at the end of the tunnel here at this point, but we really are not seeing that right now. I just checked the New York Times this morning, and we had another 74,000 cases plus overnight. We're up 39% in cases over the past 14 days. Another 1,000 people died. We're very close to that. Yesterday, we're now at about 226,000 dead now since the pandemic began, over 8.8 million cases. So the bad news is we are starting to see countries now, especially in Europe, starting to close back down again. This is having a huge impact again on restaurants and bars and leisure and hospitality businesses that have been really bearing the brunt of the pandemic so far. We're going to expect to see some more tightening of restrictions here in the United States, though our baseline forecast isn't that we're going to get another national lockdown like we had in March and April. That's a scenario that we're running for the bank, but it's not one that we really have baked into our baseline. We think we're going to see more regional shutdowns. We're going to try to manage this at least for a while here without a national shutdown. So this is going to be a drag on economic growth, and over the last month, we've actually been cutting our forecasts for GDP growth in the fourth quarter and first quarter of next year as a result of the pandemic. But what I want to talk about first, kind of where we are and where we're headed going forward. Then I'll talk a little bit about the election, possible outcomes, and the impact that could have on our economic outlook going forward. So hopefully y'all can see my slides here. I want to start first at kind of the 50,000 foot level and talk about the global economy and outlook. We just came out of the IMF World Bank meetings in Washington, D.C. There's a little bit more of an upbeat mood. I think the recovery we saw globally in the third quarter was stronger than many analysts expected, or even the IMF expected. And so we did see a pretty strong bounce off the May lows. But we had an unprecedented decline both in global economic activity and US economic activity in the second quarter. And we did see what you could characterize as a V-shaped recovery in the third quarter as a lot of these businesses reopened, at least at, maybe not full capacity in many cases, but we did see that return to work that led to big job gains in May and June and to some extent in July and August. But some of that impulse we think is fading. But I want to draw your attention to the fact that this is a very unusual, this is not a normal recession. This is a pandemic, government policy-driven and health-driven recession. So the usual rules don't apply. And to be quite honest with you, our macroeconomic models that are trained on historical economic recessions and data aren't very useful actually during this sort of a pandemic. And I think you can see that from this slide. With the big drop we saw in services activity, it's very unusual in a recession even to see big declines in services activity. Usually you see bigger declines in things like manufacturing and durable goods production on the good side of the economy. This time around, it's been the exact opposite, where we've seen the service businesses really, and consumer services especially, bearing the brunt of the downturn. The good news is we're back growing again. We're both measures globally are back in expansion territory, but we're starting to see now services businesses starting to weaken a little bit as we moved into September, and we expect further weakness to show up in October and into the fourth quarter. You can see that from some of the leading indicators that we track. The OECD has a composite leading indicator for the OECD countries, and we saw that nice V-shaped recovery off the May lows in terms of those leading indicators, and that's now been fading quite rapidly every month, and the latest data we have through September is still showing a positive impulse, but it's it's definitely fading fast, almost exponentially here, decay, and that's going to lead to a slower growth outlook as we move into the fourth quarter and first quarter next year. In terms of our overall economic overview outlook, we haven't made huge changes into our forecast. We still think we will get some sort of vaccine approved early next year. It'll probably take a whole year for many people to get vaccinated. We also expect to see some better therapeutics that'll reduce the death rates and allow people to continue about their economic activities. So we do think we'll see a nice rebound in growth as we move into 2021. But the damage from 2020 is tremendous. And even with the V-shaped recovery we had in the third quarter, we're still almost about 4% below year-ago levels on GDP, which is similar to the decline we had during the Great Recession in 2008. So we have a long ways to go here in the US. We saw the biggest declines in the Eurozone and Latin America. As you know, the Eurozone activity has been trailing off quite rapidly and with the shutdowns, and we've actually seen a lot of the positive economic surprise in Europe turn to negative economic surprises. So the slowdown is happening even faster right now in Europe than it is here in the United States. We also had unprecedented monetary and fiscal stimulus. With the CARES Act, we had over $3 trillion in government spending that was released starting in May, and that was equivalent to about 14% of U.S. gross domestic product. So we did see the positive impacts of that. Of course, the Federal Reserve was not sitting on its hands either, and they unleashed a tremendous amount of liquidity into the banking system, cut interest rates to zero, restarted their asset purchase programs, over $80 billion in bonds being purchased every month. And they've continued that. And so the Fed balance sheet has nearly doubled from where it was in September of last year. And we're seeing that support things like housing and auto sales, where people are taking advantage of the low interest rates to buy some very big ticket items. So it's a very unusual area, but I think China is really coming out the winner here in terms of the global picture. They got their pandemic under control a lot faster than many other countries in the world, and they actually are going to see positive growth this year. Only country in the world that we expect to see positive growth this year, and they expect that to accelerate as we move into 2021 to close to 8%. Just to give you a little bit of a feel for how this downturn, because I think it happened so fast, the drop in jobs in March and April was so quick. Basically in a month and a half, we lost twice as many jobs as we lost during the Great Recession that took a year and a half to play out. So that's how fast the downturn happened. And we had this kind of knee-jerk whiplash in terms of reopening growth coming out of it. But you can see here, even in terms of GDP, the declines in the second quarter were double the magnitude of anything we've seen in past downturns, including the Great Recession. And really, it's been uneven in terms of the impacts, and we've, a lot of analysts on Wall Street are talking about the K-shaped recovery, where you've got the lower income households that are, looking at depression levels of demand and job creation, especially if you have a job in the leisure and hospitality industry or retail trade or restaurant bar industries. But others that have been able to work from home, been able to continue to keep their jobs, are actually benefiting from positive stock, and home prices are feeling actually better this year than they did last year in terms of their finances. And so we're seeing this very unusual environment where consumer spending on services have collapsed, but we're seeing strength in a lot of durable categories like autos and houses that RV and marine is a big business for Bank of the West, and we're one of the largest RV and marine lenders in the country, and we're seeing tremendous growth in that portfolio. So and it's very unusual because in most downturns and recessions, you don't see big declines in consumer services. So, if you look at the retail sales report, it looks like everybody's just spending like crazy, but in reality, they're shifting their spending away from things like education and healthcare, and they're spending more on, going out to the grocery store every day and buying stuff at Target and Walmart and Costco. So that's really what's going on. And I think we're still most concerned about the labor market. The fact, we're happy that we've seen as much job creation as we have had since April. We've recreated about half the jobs that were lost in March and April so far, but we still have about 23 million folks that are still dependent and collecting unemployment insurance, and extended benefits have been disappearing. A lot of the extra $600 in pandemic benefits went away at the end of July. So people are seeing lower unemployment benefit checks. The other trend we're seeing right now is a lot of people are coming off of the regular state benefits. They only last 26 weeks. So people are actually going off of those roles, and they're actually going on emergency benefits now, which will last another 13 weeks. And that'll bring them to probably about the end of the year. But at that point, as we go into January, if we don't get an extension of unemployment support from Congress and the White House, a lot of people are going to lose their unemployment checks beginning next year. So we are still quite concerned that we're losing a lot of momentum in the labor market now, the forward momentum we had, and we still have a lot of people that are being left behind. You can see the unemployment rates here. We were looking at depression level unemployment rates at the end of April. If you include people that were underemployed, we almost had 23% unemployment at one point in April. With the recovery now, we've actually seen the unemployment rates coming down. The blue line here is the official unemployment rate you hear reported in the newspaper, and we got down to 7.9% as of September from about 14.7% in April. So we've made good progress. We're a little bit below the peak we had in terms of unemployment in the Great Recession at this point. But there's a lot of noise in these indicators. The BLS has said that, there's you could be as more as 3 to 4% higher than that if people were being reported correctly. So the point is, we still have a long ways to go to get back to that 3.8% unemployment rate we had prior to the pandemic. We're not going to get there overnight. We think we'll probably average about 7.7% unemployment in the fourth quarter. Next year, our forecast is the unemployment rate will continue to drop, but still be around 6.3% on average in the fourth quarter of next year. So we do think it'll be late 2024, early 2025 before we get an unemployment rate down to what economists would consider a fully employed economy. So we've got a lot of work there. I wanted to give you a little bit of a regional view of where we are in terms of unemployment, because you're seeing this really uneven nature of this downturn, not only by industry and by job function, but also by geography. So if your state is heavily dependent on tourism and hospitality industries, states like Hawaii and Nevada, you're seeing astronomical unemployment rates, the highest we've seen in the post-war period. In Hawaii, 15% unemployment. Nevada's at 12.6. California, my state, I'm here in the Bay Area. We're seeing 11% unemployment still through September. And you can see the state of Illinois, Chicago's state, still at 10.2%. So still the fifth highest in the country. So we again, we're seeing that big difference across states. So even though the average is only 7.9 for the nation, we're seeing a lot of states where the economic pain and labor market pain is a lot higher. And that's going to have huge impacts on state and local budgets as we move into 2021 and beyond. We still have about 10.7 million jobs that we've lost since the pandemic started. You can see in the Great Recession, we only lost 8.7 million jobs. So again, the point here is we got a lot of work to do, even with that strong growth we're going to see in the GDP report this week. for the third quarter. In terms of where the job losses are coming from, the 3/4 of the job losses so far, at least since the pandemic began, has been coming from just 4 sectors of the U.S. economy. It's really concentrated in leisure and hospitality, education and healthcare, professional business services, as well as retail and wholesale trade and transportation. Those are the sectors that are bearing the brunt of this. At least at this point, financial services, information services, construction, manufacturing has held up relatively well. That's why you get that K-shaped recovery talking point you're hearing on Wall Street. I'm a little concerned. I think some of these sectors that have been fairly untouched so far, like financial services and construction and others, will actually deteriorate a bit as we move into 2021. So I think this will turn more from a K-shaped recovery, probably more into a U-shaped recovery going forward, where kind of all industries are going to be impacted a little bit more strongly as we move into 2021 and 2022. In terms of percent declines, you can see that heavy focus or concentration in job loss in leisure and hospitality. About more than 20% of jobs have been lost in leisure and hospitality from a year ago. So hotels, insolvency is a big problem and a big issue. And we'll talk a little bit about that in a minute. But let me transition a little bit to talk about what the government's been doing about all this. So with the CARES Act, we had tremendous amount. We had stimulus checks that went out directly to individuals and households, at least $1,200 per household. We had expanded unemployment benefits for folks. We've had deferrals on things like rents and mortgage payments and credit card payments. So that has helped a lot. Consumers saw a huge windfall in terms of income from those actions. And like I said, they amounted to about 13 to 14% of US gross domestic product. So depending on how you measure it. So that's a huge impulse. And you can see this huge impact on personal incomes from transfer payments. So we've never seen anything like it. So we've done a lot more support this time around than we did during the Great Recession, about 3 times more. By our metrics. So that's why we've gotten as much recovery as we have so far. Personal per capita incomes actually surged by 15% as unemployment rates reached 14% or more in many areas. So that's unusual, right? Usually when people lose their jobs, their incomes go down, and that affects, you see a multiplier effect as they cut back on their spending, and that means more people lose their jobs, et cetera. We didn't see that this time around because of the policy support from Washington. You can see what happened to the savings rate. So a lot of folks, I was talking anecdotally, a lot of people that got payment checks, especially if they were in the Midwest and they hadn't seen a lot of cases of coronavirus, they actually looked at it almost like a paid vacation. Some folks were actually making more money with the unemployment benefits than they were in their jobs, and so they actually looked at this as almost a paid vacation, and they were out spending very aggressively in the stores over the summer, and you certainly saw that reflected in some of the retail sales numbers. The bad news is, of course, the savings rates are coming down quickly now, and with the delay in the stimulus package in Washington, we don't think anything will be passed in Washington, D.C. till after the election. Even then, if the Democrats sweep or take the presidency, I would suspect the Republicans might drag their feet on additional stimulus. So we might get either a much smaller package than what we had previously thought in the lame duck session, or we might not get anything at all until early next year when a new Congress and president is put in place. So that's the bad news. And so we're probably in for a rough few months here as we move into the holiday season. As I mentioned, retail sales have been very, very strong. Real year over year, we're up 4% year over year in real terms, the strongest numbers we've seen since 2015. And so there's been a lot of sectors that have benefited from this. You know, if you're an Amazon or whatever building material company like Home Depot, you're doing quite well. Sporting goods, motor vehicles, people have been going to the grocery store a lot more because they're bored and they're sitting at home eating a lot more. But of course, if you're in the restaurants, gasoline stores, clothing stores, electronic stores, you're not seeing a lot of benefit from that. But retail sales is not total consumer spending. And so, as I mentioned, consumers have been really scaling back on their spending on things like education and healthcare. And because of that, and those are major categories of spending, we're actually seeing spending still down about 3.2% from year ago overall for real consumer spending through August, and incomes are just a little bit above that. So without the government support here, we're still looking at a recessionary income and spending environment. On the bright side, the housing market has been very, very strong. Home sales, home prices. This is the National Association Housing Market Index. Both future and present sales metrics from this survey are at record high levels. Who'd have thought with almost 23 million people collecting unemployment benefits, but that's where we're at right now, and how unusual this is. So there are folks out there buying houses. Some of this are people shifting from the center cities to the suburbs. People are taking advantage of the work from home. A lot of tech companies here in the Silicon Valley, in the Bay Area, have just said their employees don't really ever have to come back to their headquarters, and they can work anywhere they want. So you're seeing very strong demand for housing, especially in some of these vacation communities. Places like Hawaii, Lake Tahoe here in the Bay Area, the Hamptons in New York. I'm sure you're seeing similar trends in Wisconsin and in northern Minnesota as people from Chicago decide to move to other areas. But we're not going to have a full recovery, no matter what is passed in Washington, without getting our virus cases under control, or a workable vaccine that's actually been distributed to a wide number of households. Right now, we are seeing a pullback in things like restaurant reservations, some of the daily data we track to get a sense of where we are in terms of the pandemic recovery. We're really relying on data sources we've never relied on before because of just the rapid nature of this downturn. So we're looking at alternative data sources like restaurant reservations. That suggests that there's going to still be a lot of restaurants and bars that aren't going to survive this downturn, and we're actually seeing demand pulling back again as virus cases resurge. We're seeing a similar trend in air travel. TSA checkpoint visits are still down over 60% from a year ago, and that's been trending down since the beginning of September. So again, no real recovery there, and actually we're seeing some reversal of some of the positive trends we had in June, July, and August. We're also seeing some negative trends on insolvency. More small businesses are saying they're shuttering again permanently, we saw some good recovery in some of those numbers in June and July, but those numbers are creeping back up again every week. This data only goes through the end of August, but we expect we'll continue to see increases here, especially as governments start to roll back some of the reopening measures they've done in the last few months. And also, we're not out of the woods yet in terms of evictions or defaults. Our bank, we're monitoring very carefully. We still know about 8% of our mortgage holders are not making mortgage payments or are behind on their mortgage payments. They're not being defaulted on because they're getting deferrals right now. But we know even more folks in the rental market are in trouble. This is from the Census Bureau data. About 46% of renters are still saying to the Census Bureau that in the next 2 months they're at risk, some risk, or very likely at risk for eviction over the next couple months. So right now there's some eviction moratoriums that go on into November, but at that point they end, and so we could still see a lot of folks a lot of homelessness, a lot of people moving out of their houses, and that could have a detrimental impact on the housing market as well. So here's the outlook. It's really interesting. So we had this V-shaped recovery in the third quarter. 31% is our forecast. Some of the estimates are as high as 36% growth annualized in the third quarter. That's off of a 31% decline. So unprecedented decline, unprecedented recovery. on the reopening. But again, I think that's going to not be repeated as we move into the fourth quarter and first quarter. Our forecast is we may move down, still grow, but maybe move down to about a 2% pace by the first quarter next year. Of course, a lot of this depends on how bad the virus cases get over the next couple of months. But we've been, like I said, been kind of pulling those numbers down. We're a little bit below consensus right now, but the consensus is actually coming into our view right now in terms of the outlook over the next couple of quarters. The yield curve has been very interesting. The Treasury yields have been trying to rise on the long end, starting to price in a Democratic victory, a Biden administration, and perhaps even a flip of the Senate from Republican to Democrat that the market believes would mean more government spending, which would mean more government borrowing, which would mean probably higher growth, higher inflation, and higher interest rates as the government needs to convince bondholders to buy their bonds. We're talking trillions of dollars in additional debt likely to be borrowed over the next couple of years if we do get that election outcome. So we saw that actually push up long-term yields last week, and they moved up about 15, 20 basis points in some cases. That's all changed now in the last couple of days. I don't know if you saw the stock market today. It was down about 2.5% earlier today on the S&P, and we've seen bond yields moving back down again. We're down to about 75, 76 basis points on the 10-year again. So we do think the yield curve is going to remain compressed here, especially as we look into 2021. There is a little bit of steepening going on, and could see some steepening off of additional government spending, but we think it'll be very gradual. And if we do see any rise in interest rates, that'll be pushed back hard by the Fed. I think the Fed will come in and buy more Treasury bonds if they see long-term rates creeping up. So our baseline view is that rates will just be going up very gradually as we go into next year. The Fed has already done almost everything they can do. There's not much more the Federal Reserve can do now. They've basically brought rates to zero. They've said they're going to keep them at zero at least through 2023. They've doubled the size of their balance sheet. We're seeing unprecedented growth in money supply, 40% growth year over year in M1. And so some consumers and investors are getting a little bit more nervous about inflation potential from that money supply. If you remember your economics 101 in Milton Friedman, more money usually equals higher inflation over time. We're not too concerned about that in our forecast, but we are seeing some consumers starting to be a little bit more concerned about inflation around medical care, for example, college education, rents, and gasoline and food. So we have seen a little bit of a tick up in inflation in the third quarter. Some of that's due to supply chain issues and the movement of people from buying services to buying certain goods where we just haven't been producing enough. So there's a little bit, we think it's temporary, and we don't really see a big inflation impact from this. But even the bond market is starting to get a little bit more nervous about inflation. That's why the long-term yields have moved up a little bit, at least as you look out over the next 2 to 10 years. We're not seeing any sign of panic about inflation, but definitely seeing a little bit higher inflation outlook as we go in over the next 2 to 10 years. Here's our forecast on the rates. We think the Fed's going to stay at the lower bound probably through 2024. In terms of long-term rates, the 10-year Treasury yield, which affects things like mortgage rates, et cetera, we think will move up to about 90 basis points by the end of next year. So we haven't moved our forecast at all based on what happened last week. We really don't see rates staying above 80 basis points, given the weakness we're seeing in the economy developing. Business investment has actually been holding up quite well in this downturn compared to past recessions, even though we are down, especially in energy sector and in some areas of business investment. We haven't yet seen Great Recession type declines in business investment activity. We're a little concerned about equity valuations, and you're seeing that play out right now in the stock market. If you look at the Case-Shiller or Robert Shiller's cyclically adjusted CAPE ratio, which is a PE ratio of the S&P 500. Anytime you have a higher number on this index, the more expensive the stock market is. You can see the long run average on this measure is 17. So we're definitely on the tail end of the distribution in terms of how expensive the stock market is today. Bulls will tell you it's because rates are so low and the Fed's going to keep rates low forever, and we're probably going to see more fiscal stimulus spending. But anyway, you price it, the stock market's expensive here, and it's comparable to what we saw right before the stock market crash in 1929, and just a little bit below where we were before the dot-com bubble collapsed. So there's definitely room for a pretty big pullback here in financial markets, which would obviously magnify the negative economic impacts. Companies are facing huge headwinds. Corporate profits took a hard hit in the second quarter, down about 20% from a year ago. Stock market has been taking a glass half full approach on that, expecting a pretty strong rebound in corporate earnings as we move into 2021. But I would note that corporate profits as a share of GDP have actually been dropping since 2012. And so even though we might see a pretty strong bounce off the bottom in terms of earnings, we still think the trends are somewhat negative for business investment and in corporate profitability and the stock market as we move into 2021. The period of double-digit stock market gains is going to be a lot harder to replicate, I think, as we move forward here, especially if rates start to creep higher. There are implications of the government spending programs that we've already seen. CBO just announced this month that our budget deficit for 2020 officially came in at about $3.1 trillion, almost triple from where it was at the last year. So it was as bad as we thought it was going to be. The outlook isn't good as well, and this is based on current law. So if we get additional government spending in terms of coronavirus rescue packages or additional spending packages from a Biden administration, that would add to these deficit numbers that you're seeing here. But the problem is we're seeing $1 trillion plus deficits over the next 10 years, even in the current with the current spending outlook. So that's going to mean budget deficits in the U.S. probably double over the next 10 years to over $33 trillion by 2030. This is certainly probably bad news for the dollar and interest rates as we look longer term. As a share of U.S. GDP, we're already at World War II levels of federal debt in the United States, really the highest we've ever seen in this country. And we're probably going to get above that very, very rapidly. And over the next 30 years, we're going to reach unprecedented heights, maybe close to 200% debt to GDP. And that's based on current spending outlook. So let's transition a little bit to the election and what we see happening there. Obviously, a lot uncertainty still going on. A couple of things that have happened, I think, in the past months, the markets have gotten a little bit more confident that we will see a Biden victory. Some betting markets that I track, like predicted, are showing about a 64% probability of a Biden win on election day, and almost a similar probability that the Senate will move Democratic as well. So there's a pretty strong probability right now, and it's probably reflected in the polls as well. You see some polls 10-point lead for Biden, some more like 7 or 6 point leads, but a more comfortable lead than Hillary Clinton had going into the election, especially on those battleground states. You've seen a move of suburban white voters moving towards Biden and away from the Trump administration. That's affecting a lot of these state numbers. So it looks like Biden's in better shape in states like Michigan, Pennsylvania, Wisconsin, and in Minnesota than he was in 2016. So that's what the markets are starting to price in here, and why the stock market has been pretty bullish lately, even with the rise in coronavirus cases. And what the stock market's really reflecting on, I think, is what might happen if we do get a Democratic sweep. And so I think in that sort of scenario, you're likely to see probably a pretty full implementation of the Biden economic plan, which includes trillions of additional dollars in spending over the next 4 years and over the next 10 years if those policies remain in place. We looked at this, and we've actually done some analysis with Moody's Analytics, and A couple of things got come out of it. If you take Biden's spending plans at face value, we're looking at close to $4 trillion in additional federal government spending over the next 4 years. About a little over 56% of that spending will come from infrastructure, about $2.4 trillion expected to be spent on infrastructure over the next 4 years. The rest being education, healthcare, some of the social safety net programs. If you look over the next 10 years, you're looking at over $7 trillion in additional spending on a Biden sort of platform. When you look at it in terms of percentages, that spending, as I mentioned, the infrastructure is about 59% of the added spending over the next 4 years. It's a little bit more equal as you go out over the next 10 years. You see education, healthcare percentages go up to about 20-25%. Social safety nets also increase spending on that. So that's our models basically are trained on, spending is actually real. So if the government actually goes out and spends an extra dollar, even if it's borrowed money, it actually adds to economic growth. So even though Biden is also thinking about raising taxes, if you look at all the possible election outcomes and scenario outcomes, a Biden and Democratic sweep are some of the best near term for economic growth in the growth outlook. If you look at Biden's tax policies and tax plans, he does expect to raise another $1.4 trillion in tax revenue over the next 4 years. About half of that coming from corporate taxes. He's expecting to raise the corporate tax rate from 21% to 28%. He's also going to raise taxes on high income households. So the top marginal tax rate will go from 37% to back to 39.6%. He's going to get rid of long-term capital gains taxes at the lower rates. If you're making over $1 million, it'll go back to be taxed at ordinary income. He's also going to give you Social Security taxes on folks making over $400,000 a year. So that's where the tax revenue is going to come from. And over the next 10 years, it would equate to about $4 trillion. In terms of percentages, you can see, like I said, about 57% of the tax increases coming from the corporate tax increase raise, and payroll taxes and individual taxes making up the rest of the increases. So what's the impact on the outlook? Well, so assuming that you have a Democratic sweep, which is this light blue line, you do get more spending programs through Congress. A lot of that's going to be infrastructure spending. And so that $4 trillion really does add up to significant growth, especially as you look into 2022. This comes out of the Moody's Analytics model. I think they're a little bit aggressive on some of these growth forecasts, but under that sort of scenario, their models are pushing out almost an 8% growth rate in 2022 under a Democratic sweep sort of scenario. You can see our baseline forecast is quite a bit lower than that. We're a little bit higher than some of the scenarios in 2021, but we're much lower in 2022 and 2023. But I would say we haven't fully factored in a Democratic win yet at this point. So if that's the case, I do think there's some upside to our forecast as we look into 2022 and 2023. The worst for growth would be either the current economic policies or a Republican sweep. You can see there that not much would change. And that's sort of where our baseline forecast was. Our forecast was kind of assuming that we'd get another coronavirus relief package, but not much else in terms of additional government spending. And that's why we got those lower growth rates in 2022 and 2023. So the point here is that the election outcome is going to have a significant impact this year on not only our political future, but also our economic future. One of the things I like about the spending plans is we've been saying it for many, many years. We need more infrastructure investment in the United States to stay competitive. The spending that the Biden administration is proposing is right in the places where we need to boost our productivity growth, which will boost our long-term growth potential. It will raise our deficits and debt, and even under a dynamic sort of scenario where you get an added growth, you still see about $2 trillion additional debt deficits over the next 4 years under a Biden administration and plan, and over 2.6 trillion more borrowing over the next 10 years. So I don't think it's astronomical. The U.S. government can certainly handle that sort of borrowing, but it could weigh a little bit more on the Treasury market, and you could see a little bit of an uplift in bond yields as a result of that. But I think overall, the net outcome would be stronger growth and a stronger economic outlook if with a Democratic win. I also think it helps a little bit in the near term in terms of uncertainty right now. The president's policies are so haphazard. There's been a lot of postmortems on the trade war that the Trump administration put in place last year. And they've been very mixed in terms of their impacts on the economy. And actually, most research, even the Fed has put out suggesting that didn't really help U.S. manufacturers. So with that, I will stop. I probably talked a little bit. We got, I think, 10 minutes for questions, but I'd be happy to turn it over to you, Kendra, and open up for questions. Thank you.
Great, thank you, Scott. That was so interesting. We did have one question come in, but I think one of our other attendees might have answered that the BOW baseline was the Bank of the West baseline. Is that, just to confirm, is that correct?
Yes, the BOW baseline is my forecast going forward. So I'm a little bit stronger in 2021 than some of the scenarios. Like I said, I haven't factored in the Democratic win yet into the 2022 or 2023 forecast. So that's why it's so low. It's basically assuming we get a pandemic stimulus bill, but we don't get a lot of additional federal spending on infrastructure, for example. So if we do get that, then there's an upside risk to our forecast as we look into 2022 and beyond, and probably somewhat higher interest rates and inflation as well.
Okay, terrific. Thank you. Vincent put in a question as well. That's a multi-part question about the interest rates on your slide 29. Mm-hmm. Which will stay low for a long time. What will be the impact of the massive infrastructure plans considered by both candidates on interest rates? Also, do you have any thoughts to share about those on lowering the unemployment rate?
Yeah, sure. So first question about the interest rate environment. So a couple of things that I think would happen is I think the Federal Reserve would react to huge stimulus packages coming from the federal government. So if Biden is able to get $2 trillion in additional spending around infrastructure, that would obviously mean trillions of dollars or more borrowing from the federal government. But I think the Federal Reserve would intervene and try to stem the increase in interest rates that would result from that added borrowing by buying more treasury bonds themselves. So they would be, right now they're buying about 80 billion a month in treasury bonds and other mortgage-backed securities. They would just ramp that up. So that's what economists call monetizing the debt. And the Fed's actually quite open to it at this point, given the fact that inflation is so tame. So they'd be willing to accommodate that fiscal spending, I think, at this point with support. So that's why we still have that very gradual increase in interest rates as we move into 2021. I think beyond that, there is some upside risk to interest rates and inflation as we get closer to full employment. Now, under that sort of stimulus plan, the models are saying we could maybe have another 18 million jobs created from all the stimulus measures that a Biden administration could push through a Democratic sweep Congress. If that were to happen, we would probably get to full employment sometime in late 2022 or early 2023, about 2 years quicker than we would otherwise. So it would be a quicker return to full employment. And it would be good news for the banking industry. It'd be good news for a lot of households that have right now are getting left behind. The shorter we can make this downturn, the better, and get back on track. And so anything that gets us closer to that goal faster. One of the mistakes we made coming out of the Great Recession is we didn't do enough fiscal stimulus. We really relied on the Federal Reserve alone to kind of boost growth. And what we saw is state and local governments were slashing jobs for another 2 or 3 years as we came out of the recession. So that really held down the pace of recovery, and what reason why it took 10 years to get back to kind of a more normal economy here in the United States. We're not going to repeat that, I think, this time around. We're going to learn from that mistake, hopefully.
Here's hoping. We have another question asking what's your view on CapEx in the coming 2 years?
Yeah, I'm actually been somewhat surprised at the resilience in capital spending. We are seeing weakness in some spots, particularly around energy. There's been some nervousness in bond investors as well. You're seeing corporate spreads widening out and CDS spreads widening out in some of those sectors. But overall, the markets have been quite tame in terms of their fears of corporate defaults. And we are seeing a strong rebound. You're going to see, I think, in the GDP report that comes out this week, a real strong recovery in equipment spending, which is something we didn't think would happen right away. So that's good news. But there's still industries that are going to be really hurting, like airline manufacturers like Boeing, energy, anything in the leisure and hospitality space around hotels, cruise ships. Those are the areas that are going to continue to see struggle here. A couple of things we are a little concerned about and watching, as the Fed is too, is just we know corporations are highly levered here. There's a lot of debt as a share of GDP out there for corporations. So there's big insolvency risks, and that's why the Federal Reserve has been so aggressive, not only buying treasuries, but they're actually buying corporate bonds and all these liquidity and credit facilities they've set up to try to basically keep corporate spreads low and allow businesses and consumers to continue to access credit.
Great, thank you. That's all of the questions we had in the chat. So I think maybe we can take another minute and open it up. If anyone wanted to ask another question, you can unmute yourselves and ask your question.
Can you hear me?
Yes.
Yes, Vincent, go ahead.
Yes, Scott. Quick question on the election and what might be the impact of a contested election on the markets for the next, several weeks ahead.
Yeah, I think the markets have gotten a little complacent on that front. I mean, I think as Biden kind of pushed up his lead after the first debate, the markets got a little less concerned about a contested election. The fact that he might be able to win by a high enough margin that it would be difficult, even with some of the legal maneuvers that the Republicans are planning and their efforts to stifle voting in certain areas of the country, that we'd be able to at least have a pretty good idea of we might not have total clarity in the first couple of days after the election, but there was some hope that within a week we would know, pretty clearly who was the winner. But I think you're right, Vincent. This is certainly a downside risk. If we do get a closer election, or we have to go back to recounting certain districts, or we get legal challenges. I've heard a lot of election officials saying it could be 2 weeks before all the mail-in ballots can get counted, or even longer. So I don't think that's factored into the markets. I think the markets are getting a little bit more nervous about that as we get closer to election day. And we'll have to see if the president and the Republicans are able to throw up any more roadblocks here. There was an important ruling from the Supreme Court the other day, basically not allowing a delay, basically saying that they have to count the votes from mail-in ballots on election day in Wisconsin. So that was a kind of a pretty big defeat for the Democrats, and a positive for the Republicans, who they had been hoping that they would be able to count for a week after the election, some of those mail-in ballots. So if there's other rulings like that around the country, I think there's a few other cases pending in other states. With this, they'll try to use this Supreme Court ruling to work their magic in terms of making it more difficult to count all the mail-in ballots. So we'll see where that goes. But At least right now, it still looks pretty good. And like I said, I think I'm watching those betting markets to see how the probabilities change. And I haven't seen a lot of shifting in those probabilities in the last few days. So that's a good sign that we might have some clarity fairly quickly.
Thank you, Scott.
We'll keep our fingers crossed. Thanks, Vincent.
If anyone else has a question, speak now. But otherwise, I'll turn it over to Andrea to wrap things up.
Thank you. Thanks, Brooke, for manning the chat. We just have 1 minute to go, so if there are no further questions, we will wrap up on time. Thank you again very much to Scott Anderson for taking the time to give us this very detailed, fascinating forecast. This is interesting, and it's I guess there's some positive and some frightening things on the horizon, but let's hope that we can pull through. Thank you so much for sharing your time and your expertise with us. We really appreciate it. Maybe we should have you back in 2 weeks just to sort of do the now what follow up on this.
You might not know a lot more in 2 weeks from now, unfortunately.
You'll be in high demand, I'm sure. Thank you again for your time. Thank you, Brooke, for participating. Thank you to everybody who was here today. We will follow up with an email and we will send you all the link to the recording. Please stay in touch with us. We have other events coming up and we look forward to seeing you again. Thanks again and have a good day.
Stay safe and stay warm, everybody.
Thank you. Bye.
Bye.